Welcome to today's market analysis. Happy New Year to all traders. So today we'll be looking at seven major assets that include the dollar index, gold, crude oil, Aussie, the sterling, the yen, and Euro USD. So let's dive right into it. The DXY traded above 108, rising over 2.5% in December and closing its third consecutive month in positive territory. And it consolidated below the 26-month high of 108.58 on the last day of 2024. Despite falling US bond yields over 7 basis points, the dollar remained resilient due to widening monetary policy differences between the Federal Reserve and other major central banks. Reduced holiday liquidity and Trump's upcoming inauguration could heighten forex market volatility. Let's get into the technical trends now. The index reached 108.58 on the last trading day of 2024, marking a likely short-term upward trend. On Thursday, it climbed to 109.56, which is a multi-year high. Key resistance levels to look out for include 109.2, which is a 76.4% Fibonacci, 109.29, which is a July 2022 peak, and 109.56, which is a recent high, and 110, which is the psychological level. Key support levels include 109, 108.08, which is a November 2022 high, and 108, again a psychological level, and 107.556, which is a 20-day exponential moving average. Market consolidation at high levels suggests potential further gains or corrections, depending on the technical levels. The West Texas Intermediate, that is the WTI crude oil, traded around $72.7 on Thursday, reaching a nearly 3-month high of 73.3 during the Asian session. Although short-term demand recovery expectations push prices higher, fundamental supply concerns for 2025 remain. Prices are testing resistance but have yet to enter a reversal range as supply and demand lack upward resonance. Technical rebound corrections dominated in the short term. The fundamental factors include EIA data that showed the strongest demand levels since the pandemic. Potential supply tightening in 2025 due to President elect Trump's policies, including sanctions on Iran and a proposed Russia Ukraine ceasefire, could significantly impact the market. Technical trends: the 14-day RSI is above 60, which signals a neutral to strong upward trend. Key resistance levels include 72.5, which is with the 135-day EMA, 72.54, which is the November 7 high, and 73.2, which is the 150-day MA, and 75.05, which is the 200-day EMA, which is a very important level to look out for. Key support levels include $71.53, which is yesterday's low, $70.38, which is the 100-day EMA, and $70, which is also a very important psychological level. Moving on to gold, it hit a 2-week high of $2660.5 on Thursday, rising for a third consecutive session and gaining over 27% in 2024, which is its best performance since 2010. The rally was driven by US monetary easing, geopolitical tensions, and record central bank purchases. However, the Federal Reserve's cautious 2025 rate cuts and possible hawkish shifts under Trump's administration may pose challenges. Geopolitical tensions in the Middle East and the Russia Ukraine conflict are expected to sustain gold's safe haven appeal in the shorter to medium term. Gold traded near 2630 in a consolidation phase, breaking above short term moving averages, signaling bullish momentum. The 14-day RSI is at 55, which indicates a neutral but a slightly upward trend. Key resistance levels, which include $2640.5, which is a 250R area, and 2664.5, which is a monthly high on December 16. Also, 2692, which is a December 13 high. Key support levels include 2642.5, again the 250R support, and 2624.8, which is importantly the 100-day EMA. Gold's short-term outlook remains positive, with gains depending on breaking further resistance levels and the Fed policies. The Aussie continues to remain in the bearish trend, but it rebounded over 0.62 on Thursday, supported by China's Kaizen manufacturing PMI, which fell to 50.5 in December from 51.5 in November, below expectations of 51.7. Despite weak data, manufacturing output and new orders grew, benefiting Australia due to close trade ties. The RBA remains cautious, maintaining restrictive policies to address inflation risks. Trends include in the technical segment The trading near 0.621 with a bearish descending channel. The 14-day RSI above 30, which is hinting a potential reversal towards the upward correction. And the resistance levels of 0.6242 and 0.6285, which is the 14-day and the 20-day MA respectively, and 0.6300, which is the psychological level. Important support zones include 0.6179, which is the recent low of December 31, and 0.6120, which is the March 2020 low. Also, 0.6100 would be a good psychological level to look out for, but the more important one over here is, I believe, the March 2022 low of 0.6120, which could signal extreme bearish moves. The sterling fell below 1.24, its lowest in nearly 8 months, reversing an earlier recovery attempt as risk sentiment deteriorated and the US dollar strengthened post New Year's holiday. The pair remained defensive around 1.2530 during the Asian session, pressured by expectations that the Fed will slow its easing cycle and dovish bets on the Bank of England. The Bank of England Governor Andrew Bailey reaffirmed a gradual approach to rate cuts and warned of geopolitical and trade policy uncertainties potentially exacerbating the UK's economic slowdown, further weighing on sterling. Let's get into technical analysis of the sterling. It trades just below 1.24 within a descending channel, maintaining a bearish bias. The 14-day RSI remains below 32, signaling continued weakness and no signs of recovery as of yet. Key support levels include 1.2352, which is yesterday's low, and 1.2300, an important psychological level. A break below these could deepen bearish momentum. The key resistance levels include 1.2475, which is a low we saw on December 20, and 1.2500, again a psychological level. Breaking these could boost bullish momentum. The Japanese yen has been quite an interesting pair to talk about, which has witnessed significant volatility in the past year. Currently trades as high as 157.84 on Thursday, nearing December's multi-month high of 158.07, supported by risk aversion and the wide US-Japan interest rate differential. The pair retreated slightly to 157 during early Asian trade. The Japanese markets closed for the week. The US S&P Global Manufacturing PMI for December is a key focus on Friday, while Japan's quarterly economic report next week may hint at future Bank of Japan policy moves ahead of its Jan 24 meeting. Verbal intervention from Japanese authorities could limit yen losses. Technical analysis suggests that it remains in a bull market, bouncing off the 200-week moving averages near 149.95, gaining 6.35% from bottom to top. Support levels include 157, which is the current level, and 156. Also, an important support includes 106.62, which is a 65-hour EMA. Resistance levels include 158.08, which is again the December 26 high, and 160, which is a significant psychological barrier. A break above 158.08 could target anywhere between 158.2 to 150 to 160, while a dip below key support may bring prices back towards the 156 zones. The euro has been another very interesting pair to look out for, with potential drop below parity as it has seen significant bearish movements. It fell another full percentage point on Thursday, starting 2025 at its lowest level in 2 years, below 1.023 for the first time since November of 2022. If conditions don't improve in January, the pair may post its fourth consecutive month of losses. The euro faces challenges as the ECB maintains a dovish interest rate policy. The ECB is expected to cut the deposit facility rate by 100 basis points to 3% in 2024, with further cuts to 2% by mid 2025. ECB President Christine Lagarde emphasized the goal of achieving a 2% inflation target by 2025. Meanwhile, the DXY rose to multi-year highs, trading around 109.2, supported by the Fed's hawkish stance. The pair fell to 1.0224, its lowest since November of 2022, and is trading currently around 1.025. The pair remains in a bearish trend within a descending channel pattern, with 14-day RSI is below 30, confirming the continued bearish sentiment. The 9-day EMA at 1.0391 is below the 14-day EMA of 1.0405, signaling weak short-term momentum. Support levels to watch out for include 1.0224, which is a 2-year low, and 1.020 and 1.0100. Potential down moves would definitely look for a move towards dropping below parity. Resistance levels include 1.033, 1.030, which is the psychological mark, and 1.0332, which is the November 2022 low, followed by 1.0375, which is yesterday's high. That's all for today's market analysis. Key events to look out for include the ISM PMI tonight at 2 a.m. Sydney time. The next week has significant events, including the KIGS and PMI on Monday, the European Union CPI on Tuesday, Australian CPI on Wednesday, Australian and European retail sales on Thursday, followed by the Chinese CPI on Friday, while finally ending the week with the US non farm payroll numbers and the Canadian unemployment data on Friday night. So the next week is going to be of paramount importance. Stay tuned. Thank you for watching. Best wishes from BCR.